today, but we're really going to pick off where we left off last week, so to speak. Um, but before really we jump into and we cover the material for this week, would you have a couple different homework questions that we're going to go over? This is for kind of learning purposes, so to speak. We're not going to call your parents and tattle on you if you didn't complete the homework. Simply because different people, of course, learn different ways and such. That said, we have gone ahead with able closed captions. You should be seeing those coming across the bottom of your screen now. They're a great way to, be sure that you're, kind of catching what we're saying. That my headset's working and such. I can see, the captions coming across now and all that. But that said, of course, you do have Peter joining us this week. He'll be with us for weeks 3 and 4 as well through the rest of the sessions and such. But Peter, why don't you kind of introduce yourself to everyone since you weren't able to join us last week, and maybe take us to the homework assignment.
Yeah, absolutely. I'm happy to be here. So I appreciate kind of joining in for these remainder of the weeks. Wasn't here for week one, but of course, Nick, we have both taught this session numerous times. I'll try to give some of my own personal experiences, experiences that we've shared with clients over the years, and then speak to the material and hopefully help it kind of jump off the page, so to speak, especially through the demonstration that we'll do. Having that said, I know for a fact week two begins to kind of get to where the rubber meets the road, so to speak. So let's go ahead and review week one as far as the homework is concerned, and then I'll turn it over to Nick to get us started with what we want to cover today, because I think it's going to be jam-packed. All right. Uh, what tool does a fundamental analyst primarily study here from week one? What tool does a fundamental analyst primarily study? And what we'd be looking for here out of charts, macroeconomics, balance sheets, movements of the Fed. Well, for the most part, what we are going to be taking a look at are different types of balance sheets. We're thinking about the financial statements in general for different types of companies. The fundamentals are going to get back to the balance sheets, kind of the debt asset balance that they have, which is what we were looking for. Number two, what tool does a technical analyst primarily study? Technical analysts, well, it's not balance sheets. We know that. Maybe they're looking at a few other things as well, but really it's the price points that show up on charts. It's those generally accepted or rejected types of pricing that we're going to find in the markets. So charts are what a technician is going to be focused on. Three common chart types. There's a handful that we talk about. Oftentimes, what we're going for are going to be candlesticks. You could be thinking about open, high, low, close charts or bar charts, as they're called. There are line charts. There's also point and figure charts. There's no shortage of charts out there these days, but I think the kind of three most common that go, at least in my mind, oftentimes more or less going to be that line chart, like you're seeing on, CNBC or Bloomberg, candlesticks like we like to demonstrate, or those bar charts, also called that OHLC or open, high, low, close. Peaks and troughs are called what? So peaks and troughs, really what we're looking for here are reversal points. If you're thinking about a position that maybe is working its way higher, 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 and then stops, and then works its way lower, 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 and then stops, and then continues working its way higher. That's kind of a reversal. We're bouncing up, down, all in between. That are the reversal points, which are important, and more of what we're going to glean on here today as well. How many different trend types are there? Trend types, different categories. Think about these in a few different types, but really three different types of trends is what we are looking for. Three different types of trends. Thinking about the kind of longevity, the time frames there for different trends. Primary, intermediate, short term as well. Kind of goes back to some of those Dow theory components that I'm sure you all had talked about. All right. This is more of a project here. We can go through this just quickly. Really find a stock or an ETF in an uptrend and draw a trend line. find a stock or ETF in a downtrend and draw a trend line and bring up that chart using that bar chart or OHLC, like we had said, maybe changing some of this from, OHLC to candlestick. Which do you like and better? Let me just demonstrate this for a moment in Active Trader Pro, since that's now working for me, Nick. And I'm just going to go ahead and make quick work of this. I have the S&P 500 up in front of me. Really what we're wanting, folks, is for you all to feel comfortable with the different types of functionality and tools that are there. When we look at the draw category or bucket here in the top left, there's this kind of little barbell that is the trend line. And the way that you would use this, I'm going to go ahead and identify, let's do the downtrend first. Maybe you are identifying it from its peaks down through those peaks. There's kind of a different, art of this. Are you looking at, the most extreme and it not being violated? That's one way to draw trend lines. Others might kind of say, hey, I want kind of the most touches. Where do I see that within reason this begin to reverse, begin to reverse, begin to reverse? Okay, well, that's another way to do that as well. But really, at least from my mind's eye, I'm oftentimes looking at kind of those extremes, price not getting violated until it finally does, and we see this kind of gap and go. All right, so if that was the downtrend, the opposite of an uptrend, well, you could do this from kind of its, we talked about peaks and troughs or valleys, however you'd like to look at that. And then that same concept there, do you want it to kind of extend all the way out through these extremes? I know some others that will once again kind of do the, touch, so to speak. Maybe some would start that kind of on the new trend up higher, thinking, okay, well, this is more or less where we bounced and put in our first higher low. Maybe I want my trend line to start here. A little bit subjective. I think out of the textbooks, oftentimes you're looking at, okay, when was that low in the grand scheme of things, and then kind of connect the dots towards where that extreme was. And if it begins to get violated, well, maybe you want to extend that out a little bit until you see that it's violated and then holds below, which is kind of what we had seen there for the back half of the month of April. All right, the last thing here, Nick, and then I'll turn it back over to you. It's said to go from OHLC, or that bar chart, which is the default. If you click on settings here, folks, settings for the chart itself is how you can change between the different types of candlestick views. Line chart, like we said, mountain chart, very similar. And then this OHLC, which is the bar chart, as it's called. It is going to be a different kind of look to it. It's not quite so pronounced as far as the, bulkiness or width of those candlesticks themselves. Maybe it's a little harder to see on a 1-year chart where the openings and the closes were, the highs and the lows are pretty prevalent, because that is going to be the span of the actual bar itself. So personal preference, once again, visually, how do you like to see this? Or of course, if you want to jump back and forth depending on the time frames that you're looking at, you can certainly feel free. But I know for a fact some will prefer this just because there's a little bit easier to see at that bird's eye view of the opens, closes, as well as any type of pronounced candlestick, kind of like we're seeing here or here, meaning price action moved higher and you've got that open and close defined by the color of the body of the candle itself. All right, Nick, let me go ahead and pause for a moment. Anonymous was asking maybe a quick question. Let's see here. As my cursor jump around in Active Trader Pro, if your cursor is kind of jumping around, sometimes it's just latency. Look at your settings. Sometimes you want to make sure that, of course, this is on streaming. If the internet is having a hard time, I know some that will change it to 2 seconds or updating every 5 seconds. Truth be told, I hadn't seen that really make a tremendous amount of difference. Oftentimes, if you have any latency in Active Trader, it might just be the different tools that you're using or how much data in each of those tools is being used as well. Tools in use, great place to go. I know me, myself personally, and other clients I've worked with sometimes will have, an options chain or another chart that has a lot of indicators in it, or maybe some quotes or watch lists that's kind of bogging the system down. So keep those tools in use. We do our best, of course, through Active Trader Pro to make it kind of as compact as possible, light on its feet, but nonetheless, it is a tremendous amount of data. As you can see my cursor scrolling, think about all these data points, think about this trend line, and that's even without any other types of indicators on it as well, that kind of all go into the mix. So hopefully that helps. All right, Nick. Hopefully we make quick work of that. Just the first 10 minutes for our intro recap on homework leaves a solid 50 minutes for the actual material itself. Why don't you go ahead and get us kicked off?
Sure, absolutely. And I know where we left things last week. We were talking about trend, and this really comes down to what we're looking for on that homework assignment with the three types of trend: upward sloping, downward sloping, and then neutral or trendless environment. The support resistance. Really, we talked the most about upward sloping and downward sloping. We didn't really jump into support and resistance, and that's kind of where we're going to be starting at today. A little bit of a recap, though. Pulling back up AccuTrader Pro, the S&P 500. There's a little bit of an art and science, like we talked about with technical analysis, and drawing trend lines can be a little bit artsy, so to speak. That we might draw trend lines at different places. Here I have the upward trend line. This is just the last 5 years, the S&P 500. Looking at this bounce here, and such. Other traders might have drawn it, same slope, but here, because we have touch, touch, break, touch, touch, break, touch, 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 they might have drawn it there. Downtrend line, uptrend, downtrend. But even look at this, if we take this previous uptrend, extend out to the right, well, what do we have? Well, bounce, bounce, so we can see this where if we even went longer perspective, this is just a bigger long trend, long uptrend with the moderate. And this will break down into shorter and shorter and shorter and shorter as we zoom in. We could have gone up and down on these, and then up and down in the even smaller time frame of these and such. So that said, that kind of just quickly recovers a little bit of it, drawing that upward sloping trend line, drawing that downward sloping trend line. And one of the last things I know we'd mentioned last week is we did talk a little bit about trendless environments, and specifically what we'd used to describe trendless environments was we used the Russell. And we talked about how the Russell kind of went sideways right here. This is a great example of upward trend. It's the top again. It resists going through. We have a resistance up top. We have a support down below. Breaks, comes back in. Support, breaks the support. And then, of course, what was support became resistance. We broke through, came back up through here, this became resistance again. But not only that, look at this way over here. Look at current times. Resisted again. What was support became resistance. What was resistance still is resistance with this. And we can draw some of these other levels like this, where we see resist, 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 support, resist, broke through, and even drag this up a little bit, saying resist, resist, and then now we're right at resisting that again. What was resistance becomes support. What was support becomes resistance. And we can see this happen. These concepts of support and resistance are really, really important to a technical analyst, especially when you're then starting to get into pattern analysis, looking for those breakouts of patterns. And we'll really get into that coming up on week 4. Now, that said, they can also be used for risk management. So shifting back over here, looking at this. If you've been identifying this, that have been going up, up, bouncing, well, when this happened, what might have you have done? Well, if you're trading and taking advantage of it, and you go, oh, this broke resistance, let me buy it here. Well, you might have set a stop loss right at this particular level, because if it falls back down, well, that's invalidating it. So you could use that to measure and keep a tight stop on your position for risk management. To then, if it decides to run up, you let it run up till you hit your profit target, or it comes back down and very quickly hits your loss threshold. That works similarly over here as well. And support and resistance lines don't have to be horizontal. They could be angular, like this. Where maybe if you're buying this, you see, well, if it drops back down to this, so it should bounce. Otherwise, you're exiting your position.
Hey, Nick,
And
just for a second, there was a question there, and since you had Active Trader Pro pulled up, there was a question about the percent number at the end of that line, and since you had just drawn one, I thought that was a easy enough time to interject. So that percent that you're seeing is kind of the percent move, so to speak, from the lower, left corner in this case, up towards that upper right corner. It's there. Obviously, the trend line is what we're focusing on, but kind of that percentage change. If it's upward sloping, it'll be that positive percent. If it's downward sloping, it'll then transition to that negative percent. I didn't mean to step on your toes. I know you're about to continue that thought. I just wanted to
sure,
knock that out real quick.
sure. And with all this trend analysis, everything is fractal. And we had a question on this about, using shorter time frames. Upward and downward trends can be used. Absolutely. And so really what it comes back to is, what is your trading horizon? Are you a longer term investor where you're going to be buying and holding for a year, 5 years, 10 years, 20 years? Are you looking to only hold for a couple months and such? Let me shift back to SPX real quick to look at this. So we see uptrend, downtrend. And we see within this downtrend, well, we had additional. Here's another uptrend like this. And then within this uptrend, we have downtrend, uptrend, downtrend, uptrend, downtrend, uptrend, so to speak. And so we can get very fractal with this. And if we'd been trading on a much shorter term time frame, and you see something like this happening, well, it's important that while this goes from, June 14th to August 18th, so this is 2 months, the 2-month snapshot, what's important to look at the next bigger to know that, okay, this is within a bigger, longer downtrend that you're trading against as well. And so that kind of gets to be short term, intermediate term, long term, longer term, so to speak. When you're trading these particular downtrends, it becomes really, really, really important. So again, another example, support becoming resistance. Demonstrated that with Russell, where what was support over here, like, it's just very similar. It's become resistance. We're right at that resistance. But then what also was resistance can become support. Now, something else I want to introduce, and this gets into, I already mentioned that support resistance lines don't have to be horizontal. They can be trend lines. But also, let's take a look at the last 1 year pricing with the S&P 500. We have moving averages on here. And what do we see? Bounce, 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 break. Moving averages can also act as support resistance lines. And if we shift this back over here onto a longer term time frame, we can see this. And the downtrend's a great example of resistance with the 200. Resisted going through, resisted, broke, came back through, resisted, bounced off of its support. So these moving averages can also act as support and resistance levels. Definitely something to be mindful of and be aware of. So like we mentioned beforehand, when you're trend trading, you want to have specific entry and exit criteria. Trend traders, they're not looking to catch the very bottom or get at the very top. They're looking to maybe catch the middle 60% of a trade. If stock is bottomed out, and then shows signs of recovery. Once you see that confirmation recovery, that's when a trader wants to enter it. So they'll miss that bottom 20%. Then they'll hold on to it all the way up until it peaks, and then it starts to sell off and shows signs that trend is reversing. And then they'll close and they'll miss the top 20%, catching this middle 60%. And to an extent, I've seen some analysis done on this that if you're purely trend trading, well, you might find that you don't necessarily beat buy and hold. Now, why do I bring that up? While your returns might not necessarily beat buy and hold, your volatility, and many trend traders notice that they have much less portfolio volatility. So your risk-based return, your return per unit of risk, your return for your portfolio volatility is much higher than buy and hold. Well, why is that? Well, let's even take a step back to that 5-year basis, and let's look at the COVID drop. So let's say you were just using the 200-day moving average to identify trend changes. Well, you would have gotten out, boom, here, gotten back in about the same price. But do you notice you then didn't see your portfolio do this number right here? Boom, fall even further and then recover. You would have been, in cash at this particular point, or long short if that's what you do. And then you'd have been in all the way through here. And this is when you would have exited, missing the bottom 20%, and then missing that top 20%. Let me just draw this line right here. So you can see you wouldn't have sold the very peak, but you would have sold down here. Now you see it broke, came back in, it broke again. Maybe you got out, got back in, got back out, kind of all about the same prices, but then you would have been out on this downtrend. You'd have been out. Maybe you'd have gotten back in about the same price, but you would have been out through all of this volatility of 2022. And then maybe got back in over here, see in, out, back in, about the same price. But really, here's where you would have gotten in and then stayed back in, out, back in, and then still have been in. And so while you can see where you would have gotten out and back in, you're not like buying a lot lower than where you got out, but you're able to then cut off a lot of those larger swings in your portfolio. You're able to reduce portfolio volatility. That's why many traders will trend trade with this. Now, here's some great examples on entries with trend trading. And before I jump into these examples, anything you might want to add to that, Peter, as we move forward?
I think it just dovetails into maybe answering a question or two that had come through. So catch your breath for just a minute. Let me speak at least to a couple of these questions. Maybe I'll grab the screen for just a split second from you, Nick. A question had come through, one about the thought process of maybe finding it a little bit tougher, at least right now, especially if you are newer to this, to actually drawing those trend lines. So for what it's worth, I think it goes back to what we were saying previously, and like what Nick had mentioned, here, these kind of tops are pretty easy to see, but then you've got this lower point here to contest with. And then there's maybe a little bit of a consternation here before it actually launches. It goes back to really finding those peaks or valleys, depending on if it's a downward sloping trend line. You're really just looking to connect the dots, for lack of a better term. Where has it kind of hit a peak and then floundered and then hit a lower peak and a lower peak. And that would be for a downtrend. On an uptrend, it's going to be from this valley and then to another valley, valley, valley. And it's really going to be tough sometimes to try to get that to the penny, which is why sometimes just that shape or trajectory of that trend line is what we were going for. Now, there is another way to incorporate this if you are looking at what's referred to as kind of pivot points. This is a indicator that you can add. And if I add this pivot point, well, that's that going to go ahead and try to identify some of these peaks or valleys for you. And you can kind of see where this has met up with this, has met up with this. Here we have one that's a bit lower, as we had pointed or identified, but maybe utilizing the pivot point indicator just to see, okay, based off this indicator, where are these natural peaks or valleys kind of being drawn by this actual indicator itself might help. And then the last thing that I think I would mention to get into that last question I wanted to answer was about moving averages. If you are having a hard time drawing a trend line and you're not sure the trend, or like Nick mentioned, the fractal nature of, a shorter term trend or an intermediate or a longer term, use moving averages. And the way that you would use that is if you're looking at something like a 20 period moving average, for instance, well, that's going to go ahead and begin to show you what the shape or trajectory of that trend has been for those past 20 trading days. And that's one thing I wanted to answer, Jessica. When we see kind of an SMA or simple moving average with a 20 period, and the frequency is daily, it is a 20-day moving average. It is 20 trading days. And that is because, well, what the calculation is doing is it's looking at what the closing price was for the past 20 days in the past. So that is then going to go ahead and kind of be that cheat sheet, so to speak, as to if you're not sure what the trend has been, and I say that with emphasis, a moving average is what the pricing has been. It's backward looking. It's not forward looking. It's calculating the past 20 trading days. If you're having a hard time dictating what that trend had been for that period of time, well, a 20 period moving average could be kind of a gauge on a shorter term perspective of, well, this is what the trend had been for the past 20 days. And then if you wanted to say, okay, well, what's more of an intermediate or longer term? That's when you can say, okay, what maybe is the 50 period moving average? What does that shape look like? And then, like Nick had already incorporated, if you're a longer term thought process, what is the long term trend? Well, it's upward sloping, but it's a bit less aggressive. And of course, since there are 200 trading days worth of data, it is going to be moving much, much slower. Whereas on the other end of the spectrum, if you had fewer periods or fewer days that are being factored into this calculation, well, of course, it is then going to go ahead and move around much, much more quickly because it's going to be more reactive to what is happening. That's the last thing that I would say. I'll welcome your thoughts. I'll kick it back over to you because I know we were about to talk about entry strategy. Is that when you're looking at the kind of short, just we're talking a trading week, so to speak, 5 trading days of data, it's going to have its ups and downs. It's going to have a very steep angle of ascent or a very steep decline in nature. That's because there's only 5 days worth of data that's going here. You're going to have that ability of getting kind of what's referred to as whipsawed. Might not be the best thing for your entries and exits if you're a longer term investor. Same thing if you are a day trader or swing trader looking to maybe get into and out of positions every week or 10 days. Is the 200 period moving average helping you a tremendous amount to be cautioned on a decline like this, or maybe a resumption of a trade on an incline like this? You could argue it wouldn't be. So there's no, I would say, holy grail about the time frames that you want to match up with your trading style or strategy. But you could also kind of use one thinking, okay, the longer term trend is still higher. Maybe I want to try to look for maybe a pullback to add to a long position even on a shorter term basis. Or maybe I'm a long term investor, but I'm seeing that it's beginning to actually fail at more of that. Let's just do the 20. Maybe it's beginning to fail. Okay, I'm longer term, but it's breaking the 20. Maybe I need to do some position management. Maybe I need to trim part of my position in order to lock in some profits that I've been able to gain until this is able to go ahead and maybe get right side up of something shorter term. So do keep those in mind. And I think the reactive piece goes to what you had said, Nick, about best trader I know always said, hey, I'm trying to catch the middle third of a move. Meaning, all right, well, I maybe missed out on a little bit here and there. I didn't actually get to call the bottom, but if you're trading off of this, 200 or 20 period moving average, sure, maybe you didn't get in here, but you're able to maybe capture part of a confirmation here up to, well, a little bit here, or maybe even higher. Maybe you're getting out here. Like you mentioned, you're not capturing the absolute top, you're not capturing the absolute bottom. But with technical analysis, it is not about predicting what is going to happen next. I say that meaning we do want to know within reason, if this happens, here is how I am going to act. And if this were to happen, here's how I'm going to act as well. So we like to say that we want to react to what we're seeing rather than predict. And I just say predict from the standpoint of we don't really want to front run a type of technical analysis that can get you in trouble about using rules, so to speak, and bending them more times than not. So we want to be reactionary with these signals that we're getting rather than saying, okay, it looks like it's going to break. I'm going to go ahead and get in now. Well, what happened? Well, it went back down lower and then it went back up higher. Are you getting in roughly around the same time? You could say, well, yeah, Peter, it didn't really matter. I got in here and I sweated it out for a day or two, but look at that. It went back up higher. Well, the reason that we want to be reactive to this actually holding and pushing higher on our entry is that, well, what if it looks like it's going to go higher here and then doesn't and flounders? That can get you in hot water, which is why we're really looking for it
Big
to
time hot water.
break a trend line, a moving average, some concept of support or resistance, and hold, kind of like what we're seeing here for a period of time. We want to make sure we're protecting ourselves, protecting profits, reserving the right to get back in if price action kind of proves to us that it's in better shape and gets out of that hot water. So I know that's a bit long-winded, but I think that was maybe 4 questions I wanted to try to answer. I thought it all kind of dovetailed into what you had talked about so far.
And we can dive even deeper to that from examples. We talk about remember talking yesterday about how a trend is like a big boat. Now you can see it start to move. Well, you start to get too reactive, too predictive, so to speak. Well, think about a car, and you might be sitting passenger in a car, and you notice that every time you turn, well, what's going on? Well, the driver turns the steering wheel, and you start to try and preemptive that and go, well, every time the driver touches the steering wheel, that means they're going to, well, maybe they're just touching it to hold it, not to move it and such, that you can then get ahead of yourself quite a bit, so to speak. That's what technical analysis is all about, is looking at what's happened, not trying to predict the future, but describing what's happened. And naturally, it's going to be lagging. It's going to be a lagging indicator versus a leading indicator with that. You're not going to see, the future before it happens, but you'll be able to look at and be able to more easily, more quickly identify changes based on some of these indicators. Now, there's a couple of things that I know that we want to address. We want to talk about the session to be sure that we look at from homework perspective. One thing I think would be good to address is talk about moving averages real quick, since we have a chart pulled up. So Peter right now has a 20 period and a 200 period moving average, and we can get either a show of hands, so to speak, or let us know through Q&A which one you think is moving faster, the blue line or the green line. Which one you think is moving faster? And just because I know Peter's setting up his chart, I think I'm going to use another example real quick, and we'll use it with SPY. And really, I want to highlight things as well. And this is a little bit of an exercise that I've done with some other traders and such, but I'm just stealing the screen. I have SPY pulled up, but I'm actually going to come up here to settings, change the colors to white. We'll go and we'll move the Bollinger Bands. And our move is really short-term moving average. But with this, the red's the 20, the blue's the 50, and our green is our 200. What is price doing? Well, we can see price was trending up, and then the 20 started to move down. So likely shorter term, price is moving down in here, but intermediate term is still kind of moving up, and then intermediate term shifts, and so now we have a little bit, we can guess that now intermediate term trend is down, but look at this 200, it's still moving up. So longer term is still up. And this can help us not to miss the forest for the trees. So we don't get so laser focused on the short term. We can see this again. Up, down, up, down, up. But what's going on with the intermediate term? Still going up like this consistently. Over on the left, see long term going down. And so these are tools to help us not get too focused on price. This isn't predicting what's going to happen in the future. This is helping us describe so we can see in this time frame right here, well, we know price was going up and then down and then up and then down very quickly, where we see the blue more consistently going up, and so over a little bit of a longer term, the intermediate term going up, but then has been longer term dropping down and then recovered. Now, let me add on to here. I'm just going to add one more moving average real quick. And this particular moving average, I'm just going to modify it to be a 1-period moving average. This is effectively now going to be a line chart. And we can see jagged close to close to close, price down. And we can see price up, down, up, down, up, down. In this red shorter term moving average, reacting more with price. Kind of describing what's happened, but smoothing the data out for us. That's what indicators do. And this is kind of giving a little bit of a teaser into next week on this. But I think this is a great example to really describe which ones react the fastest. A 1-period moving average, it's effectively a line chart. We have and then we'll also add on here frequently a 5-period. We'll modify this real quick. Make this a 5. And you can see it reacts faster than the 20, but not as fast as just price does. And then the 20, and then the 50, and then the 200. So a shorter period moving average is going to react faster. A longer period moving average is going to react slower. And there's a trade-off with this, with relevance, reliability. The 200 period is going to be more reliable, but less relevant. The 20 is going to be more relevant, but less reliable on that. So that said, I do want to shift back over here to the slides. I want to talk a little more about these breakouts that I was adjusting beforehand. Breakouts can be good triggers for entering a trade. Like we're talking about with support resistance. Price breaks up above or below. It can be the reason to enter a trade. Let me shift back over here to our Russell chart, to this example right here. Price broke out above what was our previous resistance point. This right here. So you might have then entered because it broke out above that previous resistance point. Now, when you're doing this, there's some other things to keep in mind. You might want to use different filters for it breaking out above those particular points. Now, what might those filters be? What might they look like? Well, you might say just intraday going above this. That's when you want to get in. Well, maybe you then say, not intraday, but it needs to have, a close above it. That's when you want to get in. Or maybe you then say that it needs to have more than one close, and that's when you want to get in. Or it needs to have a certain percentage above it. That's when you want to get in. There can be different ways you can, of course, filter that through and say, well, it needs to do this at least before I jump in. And we can then see, well, if we wanted a close above it, well, depending on if we had this little box right here, well, this right here, we'll zoom in again. Here's our close above it, or our second close above it, or just draw this from the top of this box right here. We can see, talked about percentages with this line. We're 1% over it, or 2% over it. Up here, we finally at 2% over it. But what you might have done is, kept a very strict exit criteria that if it breaks back down below this into this box again, that it's time to get out on here. So definitely something to think about with this when you are looking to place these trades. To not only have your entry criteria, but also your exit criteria. Some great examples of this downtrend breaks the downtrend. This might be where you get in over here, or draw this. You can visually see we had this little bit of a gap here. Bounced, was a little bit of support, resistance, and then you might have gotten in over here instead. Leg up, and then now we have a little bit of a support line over here that if it drops back, you could trade off of some of those things. Exiting as well. Breaking through a trend line could be a good signal for it's time to get out. Exit through right here, boom, or over here, or the moving average crossover and such with this. And this kind of gets into, we shift back over to this, because I think this provides a really good example that relevance versus reliability on your exits. Let me zoom back out here and we shift over a little bit more. We'll draw a trend line. With this trend line, you might have drawn something like this. You might have drawn something like this. Like that, touch, 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 or these touches. I'm gonna extend these out to the right real quick. You can see we actually kind of resumed into that trend line. Extend the right. Now we'll zoom in real quick. This is the COVID drop. So you might have exited when price crossed a 20 period moving average. You might have exited when price crossed the 50 period moving average, when price broke through your trend lines. That could have been when you exited. Price crossed below the 200 period moving average. Or even you don't have to exit all at once. You might exit a portion of your position, a portion of your position, a portion of your position, a third, a third, a third, crossing the 20, the 50, and the 200 period moving average and such. Or even some traders, and we'll get into this more next week, moving average crossover. The 20 crosses the 50, or the 5 crosses the 20, or something like that. That might be where they exited and such with that. Peter, anything you might want to add to this, kind of the
I
entry
think,
exit standpoint?
yeah, I think that, I mean, entry exit, um, Nick, you and I have worked with thousands, tens of thousands of clients. Everyone has their own, unique methodology, but at least the best traders that I have seen do have some framework for what they're doing. And that's what I wanted to go ahead and echo was, I think for me, learning about investing, given that I'm so frugal, I thought, well, I'll have a diversified portfolio and I'll buy 10% in my portfolio of each company and then I'll get in or out. But that thought process, like you had just broken down, of even if you're, let's just say, have a model portfolio, 10 positions, 10% a piece, just rough numbers, folks. This isn't a perfect way to do it. I'm just trying to make this easy. Even within that 10% investment that you're looking to put towards a company or an index, an ETF, whatever it might be, when Nick's really hitting it on the head as far as turning the corner for position management, it doesn't necessarily mean that you have to be all or none, or okay, if it's above this, that, the other, I'm all in, let's go. And if it's below this, like I got to get out. You certainly can, and that's a simplified way to do it. But as he had mentioned, or like I had pointed out previously as well, you're hearing these themes. Okay, maybe I have a full investment at this point, and then it begins to break down below a 20. That's when it's thinking, all right, you gotta prove it until you're above the 20. I need to maybe pull off a third of a position, whatever that percentage is to you. If it then, is able to resume back above it, maybe you go full invested. It's almost like a checklist, so to speak, or a checks and balances on if I'm above this, things are looking great. Short-term trend, long-term trend, or immediate, we're winning these battles. And I almost think about it, for lack of a better analogy, for sports fans out there, baseball, you're winning lots of innings. You want that to go ahead and lead towards winning the game. But if you start to lose an inning or two and give up some runs, whatever it's going to be, lose that 20, lose that 50, you're getting closer to a 200. Maybe you're peeling back that position. Hopefully, in peeling back those positions, you have been able to capture some profits. The second thing that I would say from a realization standpoint for me was, if you are, let's take these moving averages, of course, you're going to be more subject, as we had said, towards a whipsaw more commonly on a shorter period moving average, because it has that flexibility to kind of whip higher, whip lower, whip higher, whip lower, given the shorter amount of time, or I should say, shorter, how do I put this, fewer data points that are being factored in. So that is going to have more of a trajectory shift up and down, up and down. If you were using, let's say, that 200 period moving average, and that period moving average it's got a little bit of a tilt to it, but broadly speaking, it's slightly higher. Broadly speaking, it's slightly lower. That is almost at times where, in my trading or trading that I've observed from other traders, they have been kind of okay with saying, you know what, I'm going to walk away if it's below this 200 period moving average, because if it bounces back up tomorrow or a week from now, has that 200 period moving average really changed a whole lot? No, more times than not, not really, just given a standpoint of a few days worth of trading, unless you have a very extreme price move. All that to be said, if you were to get out on that 200 period moving average and then you get back in, okay, maybe you saved yourself a few bucks and you're thinking, okay, well, gosh, if I would have gotten in at the bottom, think about that. But the point was, you didn't have to be stressful hoping that it gets back to that 200 period moving average. The point is that if it's flat, you might be subjecting yourself depending on how aggressive you are on your entries and exits. But if you're just using that 200 as a litmus test, you might get a little bit whipsawed on a little bit of a percent here or there, here or there. But then think about when it stays right side up of that 200 period moving average, kind of how long and how much price appreciation there was. So I think that's just to be said of in this day and age where we have some, mostly commission free trades, Nick. You and I have been doing this so long. I used to have to kind of think about, well, if I'm only putting a few percent of this 10% position in my little portfolio as a college kid, that $32 commission, that $25 commission, that might eat away. Now we've got a little bit more flexibility in this low cost commission environment. Fees are essentially next to nothing. Being able to say, you know what, it's just really the price point. Maybe I'm getting out at 100, I'm back in at 150 cents. What does that really matter? Okay, I missed out on 50 cents, but when it does turn the corner and stay right side up of that moving average, look about that gains there. So that's a great example there. What is that, late October there in November, Nick? If you were very, very strict and said, if it's below the 200, that very moment in time, I'm going to get out. If it's above that very moment in time, I'm going to get back in. You can see where on that day there, you would have gotten a few days where, yeah, you might have gotten chopped up. You might have lost out on a quarter of a percent, half a percent, this, that, the other, regardless of where it was. And then even on that gap higher, some folks think, oh, it just gapped up above the 200. Let me wait until maybe it comes back. Folks, if there's buying pressure and something's moving higher, it's because the buyers are in charge. And that's the camp you really
Hmm.
want to be in. You want to be looking for, if it's above this, I don't mind spending a little bit more because I'm hopeful that this sustains. And I think that's a great example right there, where maybe there was a couple, a few days where you're kind of in, out. It's negligible in the grand scheme of things, looking at a price point going from the, what do we got, 420s upwards of 450 dollars, whatever that price point is, here and now, even upwards of that. So just be mindful that as a trader, for me, I'll raise my hand, it was tough to take a small loss, but a small loss is a manageable loss, and it lets you have a clear head about what it is you're really trying to accomplish. Going back to just kind of that baseball analogy, you're going to have a few strikes here and there, but what you're looking for is a rally. You're looking for a kind of prolonged and sustained trend that you can then profit from, far offsetting those little manageable losses here and there and actually turning into sizable gains, which is, of course, why we're taking these risks. We're looking for a ideal risk reward scenario to pay off.
And I'm just drawing some of these lines here so we can see some of this that, let's say you were going off of it just closing below. Well, it closed down here, you would have exited down here, and it came up to here. And you might have then gotten back in and you might have missed on that. This says 0.65%, 2/3 of a percent upward move. Well, then it dropped down from there. You've gotten out over here. Well, you then would have, of course, not had this down if you then got it down here, but you would have then taken another, 1.25% loss on your account as it dropped here, but not had this further portfolio volatility. We can see about 1.4% from here down to here, but you wouldn't have had this further 1.5% drop. But then also, if you got out down here, you might have not gotten back in until this close over here, missing out on this 3% upward move. And you might be kicking yourself going, man, I'm missed out on that extra 3% upward move. And yes, you kind of got chopped up a little bit here, like Peter was saying. But if you got in there, well, you'd have stayed in from there all the way. You still would have been in, just 22% upward move here. And again, this gets into maybe you're missing the bottom a little bit of the move, but there's no way to know, well, would this have been reversed and you just missed out on 3% down here? Or I know a lot of traders. Let me zoom back out a little bit more. Let's take this a little bit further back. We'll zoom into here. They looked at this and it just broke again. This hit this. This broke again. Hit this one. Oh no, this is a fake breakout. And then they held and they held and they held. And even with this right here, how much this actually dropped? Another 3-4% on here, 15% on here. Sometimes taking those smaller losses can be better than some of those larger losses. And this right here is an even better example with this, that you have it come break up, come down, almost come up. You're like, this is going to break up. So let me just go in because I don't want to miss out on this having been the bottom. Well, it then continued to drop more from here. And, I guarantee I've worked with a lot more traders that they can remember that one time when I could have made 10% on that, but forget about the other 9 times that getting out saved them 10%. And there's so many traders get focused on what they could have made. They forget about all the other times that being diligent with their risk management prevented larger losses with that. So, couple other things on here. I know we have a bunch of questions that that came in with this. I do want to hit on. I know we're asked about MACD and such, for example, relative strength index, RSI, momentum indicators. We'll be jumping into those next week during week 3. And let me just pull this up real quick to kind of share this with everyone. Week 3, of course, we'll be getting into technical indicators. Week 2, if you take a look at the slides, it's the same slide deck for week 1 and week 2. We only really covered about 3/4 of the slides week 1. That's intentional and such. We don't really dive much into indicators in week 2. Week 3 is really that fire hose where we then introduce trend, momentum, volume, volatility indicators and such. We spend a lot of time relatively on that, but there's a bunch that we cover. We're just really trying to highlight the importance of trend identification this week, and that's why we've spent so much time on it, because it's really important with that. And we have introduced some indicators, namely moving averages, as a way to help us identify trend. You shift back over here to find that correct chart. And this is a great example of this, that we can see the different moving averages helping to identify trend. And I can delete that one again, delete that one again, and they can help us see, well, which way is trend going? Right here, we can see short-term, intermediate-term trend upward, long-term's down, but then it starts to move upward again. And so on with this. And if we just shift back over to SPY, we'll take a look at the last 2 years. We can see had been going down like that 200-day was showing, and then now it's starting to move back up, helping you to not miss the forest for the trees. That's what a good indicator will do. That's what these moving averages are trying to show. Now, we will also get into, we'll talk about, exponential moving averages versus simple and such, and those differences, other ways to identify trend and such as well. With that said, we've pretty much come up on time for the material that we wanted to cover today. For those that just only set aside an hour of your time, maybe this is your lunch break, that you don't have any more time to share with us, we thank you for coming. We thank you for spending an hour of your time. There are quite a couple questions in our queue. I'd like to take a little bit of time to answer. I'm sure Peter would as well. So for those that need to drop out and leave, you are welcome to now. There's no additional material that we're going to cover. Now we just want to hit some of the questions that came in. Now, a couple questions on in essence wash sales, shorter term trading. I want to touch on. We're asked, aren't you disallowed to re-enter a stock for 30 or 60 days once you exit? And the short answer is no, you're not. There really isn't a time where you're not allowed to re-enter a trade. Now, if you're trading mutual funds and you go in and out of a mutual fund too much, I know, for example, Fidelity funds, you might get an excessive trading restriction and you might be prohibited from buying into that specific fund because those funds are not designed to be actively traded, not like an ETF is. From a wash sale perspective, all it means is the IRS is not letting you take the loss for a bit of time. And what this comes from is there were traders that would have this very, very large loss. And then December 31st, they'd sell it so they can take the loss on their taxes, but they didn't really want to get out the stock. They think it's going to go up, and they would buy it back January 2nd. Well, the IRS got, wise to this, that they didn't want them to reduce their tax obligations. So they then prohibited them from, they disallowed them from taking that loss. In essence, what they said is, okay, you took this $10 loss, but you bought back in. Well, you're not allowed to take this $10 loss yet. You got to wait until you sell the new position before you can take the loss. And you have to be out of the new position for 31 days. And that's where it kind of goes backwards that, well, then traders try to get smart. Well, as opposed to selling on December 31st, buying back on January 2nd, well, they'd sell on December 30th. Sorry, they'd buy on December 30th, sell December 31st. That would also washes backwards. That's where the 60-day window comes from. But all it is, if you have gains, the IRS is happy to let you take gains and pay taxes on them. They just don't want you to sell at a loss just to realize the loss. They want you to realize a loss when you're then moving on to another trade, so to speak, with this. So hopefully that answers. We got 2 or 3 questions on wash sales and such with that. We're also
Got it.
asked about. Oh, go ahead, Peter.
Well, I was gonna say I've got a few ready to go, but if you already had your eyes on one, go ahead and then turn it over when you've covered your few.
Sure. Was also going to address about Christine mentioned you sell position, you sell partial position. Do you sell the shares you bought at a high or low price, or does it matter? And by default, Fidelity will sell your oldest shares first. First in, first out. Many traders will select the shares they want to sell, and they'll be tax conscious on that. That maybe they might sell shares they have a very small gain in first. That way they can realize larger gains or losses when the timing works better for them. Or they might sell more recent shares first. If you've bought shares a month ago, bought shares 3 months ago, bought shares 6 months ago, they might sell the most recent shares. That way those longer shares can continue to work towards that year and a day to be long-term gains or losses and such. Really, that's going to come down to, between you and your tax professional, what's going to work best for you. There are some traders that Peter and I work with that they trade so much that they're considered to be more not quite professional, but they might actually mark to market everything at the end of the year. And I know this gets into some option traders. If you're trading options on index, well, if you have a gain or loss, it's automatically realized December 31st. And any gains or losses, you pay tax on December 31st. And your position, your cost basis resets January 2nd going forward. And so really it's going to come down to your specific position. If you're trying to realize losses to offset gains, if you're okay realizing a couple more gains for tax purposes on which ones that you sell with that. Anything you might want to add to that, Peter, or another question you want to grab?
I think moving on, I'll try to do a little bit of a lightning round on a few of these. There was a question about when we get into concepts of position management, there are different order types we can use. A stop loss order is one of those that was discussed as far as a percentage to use. We will talk a little bit about that next week from the standpoint of actually maybe another indicator that's called the average true range or average true range percent that can factor into the percentage that you might be looking to use as appropriate for a stop loss. So we will get into that a little bit further, but that is another way to set up an exit strategy for a position based off of kind of a percent pullback, so to speak. So I wanted to address that. Simultaneously, there was another question about the ability to actually enter into a exit strategy simultaneously, maybe with the order entry, and you can. There are a few different tools and order types that you can do this with, but the trade and then conditional type allows you to set up a few conditions. And it's just kind of a sentence if you just spell it out saying, okay, on a one triggers the other type of order, it says, if this order executes, then go ahead and place order B. So for instance, if you wanted to, let's just say, buy, 10 shares of something at market, then if that fills, which of course market order will, right away, go ahead and set up this order. A stop would be something that's down below saying, hey, I want this to go higher, but if it drifts down to 515, go ahead and get me out. You could also do it on the other end. Say, okay, well, I want to make money, right? That's why I'm doing this. So if it gets up to 530, then go ahead and sell my shares, get me out. This will happen, of course, one after the other. There's also the ability in some of our other classes that will detail that says, okay, if my order to go ahead and actually buy takes place and I do get those shares at market, then go ahead and set up both scenarios. I'm hoping to make a $10 profit up at 530. But if it doesn't about face and drifts down to 515, I need to take that $5 loss and get out of the position here. We'd be looking for a $5 loss to try to get that $10 gain or about that 2-to-1 risk reward scenario. Other courses that we offer get into more of the order types. If you have interest of this, you can certainly take a look at those or online. We'll try to point to some of those coming up as well. Another question
Peter,
that had come through. Yeah, go ahead.
if you could, while you have the chart pulled up, I want to demonstrate this real quick. Go to technical analysis for us. And actually, before you do, change this over to SPY versus SPX because this doesn't really work on indexes, but it'll work on ETFs to track indexes. And add on the support and resistance for us. This is a support resistance levels powered by Recognition. It's a little bit black boxy, so that they base it on, of course, where there are a lot of closing prices and such. You can left click and then modify, look at short term, intermediate term, long term on that if you want. But if you are not quite at the level yet where you're comfortable drawing your own support resistance levels, this can let Recognitive Pattern Analysis draw them for you. That said, if you could also go up to trade and orders and then trade armor. This is another tool that traders will use to place stop loss orders with. Now, this will pull up a chart as well, and it will also feed through those Recognitive support and resistance levels, in addition to 52-week high and 52-week low levels on here. So I just wanted to touch on these, Peter, before you moved on.
Yeah, no, that's great. Different avenues. That's really what we're getting at, right? Is that there are so many different angles, avenues in order to go ahead and look for this information, and highly encourage that as well. If you are still newer to this, or rather you've been doing this for a while, but still maybe uncomfortable drawing those lines for yourself, you can utilize some of those powers as well. Let's see. Question had come through about extending those trend lines on the draw tools and draw functionality. If you have a trend line, where did it go? If you've got a trend line, for instance, like this 1-year trend, well, it's because it's SPY. Sorry, folks. I never look at the ETF. I'm always looking at the index. If you have the trend line itself that is drawn, you're going to have the ability to click on those drawn objects, and you can either extend to the right or extend to the left, Or if you have a trend line that you just want to pull somewhere else, you just kind of hover over the end and this little icon should appear. That will give you the flexibility to kind of move that, as we call it, an anchor point, meaning where is this trend line being anchored from and then to. And if you hover over on either side of that trend line, it'll let you change the kind of tilt trajectory, this, that, the other. Next week, we will talk quite a bit more about exponential moving averages, lots of other indicators. We will talk about exponential moving averages, which differ from simple moving averages just in their calculation. They are very similar. They are very adjacent to each other as far as how they're calculated. There's just a subtle difference, which is going to change the shape or trajectory slightly. Moving average, crossover, divergence, convergence, divergence is a MACD indicator. We will talk about that one as well. I'll do my best to try to share a chart like this, which tries to demystify. MACD is really just looking at when the shorter period exponential moving average crosses up above or down below the longer term moving average, which is being calculated. And then I'll try to demystify what you're actually seeing down below. When the shorter moving average moving up above the longer moving average, it gets above kind of this midline, this 0 point. That's this red line that you're seeing. When it moves below and the faster moving average is now below, well, it's crossing from above down below that midpoint, kind of like we're observing here. The kind of actual green dotted line, nothing more than a moving average of this line that we have. And then the histogram is really just showing the difference in between. Nick, I know the MACD is a popular one, but I think it is maybe a little bit misinterpreted. So that's what we'll spend a little bit of time next week on, as well as many other moving averages. The gang's all there. We'll talk about that as well to ensure that everyone's comfortable with what they're seeing on the MACD line, what they're observing from the signal line, which is nothing more than a moving average of the MACD line, the histogram, and then of course, as this line is either up above the 0 line, in between here as well. All right. Hopefully that answers those other few. And then Michael, yeah, dovetailing off that moving average, we'll talk about it more. It's really doing the legwork for us. If I just looked at this chart, could I, for myself, say, okay, when is the moving average crossing? You could, but that is what this indicator is attempting to do, is kind of do that legwork for us to say, if it's above this lateral 0 line, then I know that it is the shorter moving average above. That's what MACD is trying to do for us. The last thing that I'd say on that, and then I'm going to go ahead and take a step back until you are finished, Nick, is hopefully you're observing, and especially when we get into indicators next week, folks, there's not just one style. There's not just one approach. There's not just one indicator, at least that I have found. Nick, I don't know about you either, but the best traders are able to use a number of different scenarios, a number of different things, like a downward sloping trend line, maybe like moving averages, maybe like a MACD, and being able to see, okay, well, maybe my signal's up above or below a moving average. That's my entry. Maybe you want to take it a step further and say, okay, well, I want it to be not just price action above or below, but I want these moving averages to be right side up. I want MACD to be up and above. And you would have gotten a signal maybe back here. Or you package all that together to say, I want price action up above. I want shorter period moving averages up above more intermediate moving averages. And I also want to make sure that we're breaking up and out of a downward sloping trend line. Now, this would be the absolute low. This would be your price point in getting into a trade on price action above the moving average. This would be your entry for getting in when MACD is up above. This would be your entry for all of those things and more. Like we said, did you miss out on a little bit from here to here? Yeah, you did, but you would have gained from here all the way up to more or less here. And what it would have done is kept you out of hot water on a false signal here, or a false signal here, or here, or here. That's why looking at numerous things all together might be able to go ahead and give you a little bit more confirmation that this move is for real. Jury's still out. You want to see that price action continue, but it will look to try to get you out of hot water and maybe avoid some false signals. Hopefully that helps out. Nick, I know we're at that 15-minute mark. Once again, this is already a little bit of a foray into some of what we're going to talk about next week. So we've already done a little extracurricular. I'll give you those final words and then we'll step away.
Perfect. I appreciate that, Peter. Maybe one other thing I'd like to show is for those that do want to add something like a simple moving average to your chart. You go up to indicators in the top left-hand corner, and I like to search for this, type to search. And so I'll type in SMA. You prefer an exponential, you could type in EMA. You can also find it alphabetically. But this is how you can add it to your chart. And once it's added, you can, of course, left click on it to modify it to, change it from a 20 to a 5 to a 50 and so on. We're really going to dive deeper into these next week. And for those that were interested in how I actually was just showing the moving averages, I actually came over here and the color of the bars, I changed the color of the bars to just being white. So they're still there in the background. They're blending in with the screen. If you're using a blue background or a black background, well, you can see white bars in that case, but you might then change them to black instead, and then they'll be hidden on that particular basis. That said, there's a lot of information that we have to cover next week. We'll be talking about all the different indicators next week and such. I know that even though we're spending an hour on indicators next week, we have other classes where we'll spend an hour just on trend indicators, just on momentum indicators, just on volume, and then volatility. We necessarily break what we'll spend an hour on next week into 4 hours and such. And we have other classes that we will, for example, spend just 30 minutes on just the MACD indicator, or 30 minutes just on RSI, or 30 minutes on moving averages and such, that we further break things down from there. With that, though, again, I want to thank everyone for joining us, for spending an hour of your time with us, an hour and 15 minutes of your time with us. Hopefully, you found this to be a good investment of your time. We do really appreciate it. We look forward to seeing everyone back next week. It'll be the same bat time, the same bat channel for those that might be old enough to
Yeah.
grown up watching some of the old TV there. We'll um, we'll see you next week.
Take
In
care, everyone.
addition,
Thanks.
we will also have our Friday market briefing. We'll be kicking off at 2:30 to 3 o'clock this afternoon and such. And then we'll have our off the charts with Constantine. Be kicking off right at 4, right as the market closes, for those that enjoy our market briefing sessions. And Peter's pulled up a good screen grab for our content that we have for this week, of course. Um, Thank you, everyone, for joining us, and we look forward to seeing you in future classes.